My name is Saliza Sulaiman, and I will be facilitating today's session on tax planning for companies, continuing from where we left off in part 1. Over the next 15 minutes, we'll delve into key strategies for managing and reducing tax liabilities through effective asset acquisition, disposal, and control transfers. Our primary objectives today are to understand and apply tax planning strategies that reduce tax payable for companies. We will explore how strategic decisions around asset acquisition, disposal, and control transfers can optimize tax efficiency while staying compliant with legal frameworks. Our discussion today will cover the following topics: acquisition of assets, disposal of assets, and control transfer of assets. Each of these areas plays a crucial role in tax planning and can significantly impact a company's tax obligations. Tax planning for companies involves structuring financial activities to maximize tax efficiency and minimize the amount of taxes paid. Effective tax planning ensures that companies not only comply with tax laws, but also optimize their financial performance by reducing unnecessary tax burdens. The method of acquiring assets, whether through purchase, lease, inheritance, or other means, can lead to different tax implications. For instance, purchasing an asset may allow for depreciation deductions over time, while leasing might enable the deduction of lease payments. The timing of asset acquisition, particularly if done late in the tax year, can also influence the amount of capital allowance claimed, even if the asset is only used briefly within that year. There are 4 primary methods of acquiring assets: outright acquisition by cash, acquisition through term loans or overdrafts, hire purchase, and leasing. Each method has its own tax implications. For example, outright acquisition by cash allows for capital allowances to be claimed on the full cost of qualifying assets, while acquisition through hire purchase means capital allowances are based on the installments paid during the year. When acquiring assets outright with cash, the qualifying expenditure, QCE, is based on the full cost of the asset, except for passenger vehicles, which are subject to restrictions. Capital allowances, including initial allowance, IA, and annual allowance, LA, can be claimed on the full amount. Similarly, acquisition through a term loan allows for capital allowances on the full cost, with the interest on the loan deductible as a revenue expense. In hire purchase, capital allowances are calculated based on the installments paid in the current year, not the total cost of the asset. Initial allowance is given for each new installment paid, and annual allowance is computed on the accumulated capital portion. For operating leases, capital allowances cannot be claimed as the lessee is not the asset's owner. However, the full leasing charges are deductible as a revenue expense, subject to restrictions for passenger vehicles. Disposing of assets can result in capital gains or losses, which have different tax implications. It's essential to understand these implications to plan for potential tax liabilities or deductions. The tax treatment of gains and losses can vary depending on the type of asset and the disposal method. From a taxation perspective, the key consideration is the difference between the tax written down value, TWDV, and the disposal value, DV. This difference results in either a balancing charge, BC, or balancing allowance, BA. ABC, when the DV exceeds the TWDV, is added to adjusted business income, while a BA, when the DV is less than the TWDV, is deducted from it. In contrast, the accounting perspective focuses on the carrying amount or net book value, with gains or losses on disposal being non-taxable or non-allowable. Control transfers are structured to avoid immediate tax consequences, such as capital gains tax, balancing charges, and changes in capital allowance claims. This strategy is particularly beneficial within groups of related companies, allowing for optimized tax planning across the organization by maintaining control over assets. In a control transfer situation, assets are deemed transferred at their residual expenditure, avoiding balancing charges or allowances. There's no disposal value or selling price recorded, and the acquirer continues to claim the same capital allowances as the disposer. In contrast, a non-control transfer involves transferring assets at their disposal value, which could trigger immediate tax consequences such as a balancing charge or allowance. Control transfers help minimize the recognition of gains or profits by transferring assets at their residual expenditure rather than market value. This approach avoids triggering a taxable event, reducing potential tax liabilities that would arise in a non-control transfer situation. Another advantage is that a control transfer avoids triggering a balancing allowance or charge, which would typically occur in a non-control transfer where the disposal value is compared to the asset's tax written down value. By not creating an immediate taxable event, the company can defer or reduce its tax burden. In a control transfer, there's no defined disposal value, so no taxable event occurs at the time of transfer. This differs from non-control transfers, where setting a disposal value could trigger capital gains tax if the value exceeds the asset's tax base. Additionally, the acquirer in a control transfer continues to claim capital allowances based on the original residual expenditure, maintaining the same depreciation schedule without resetting the capital allowances. In conclusion, effective tax planning for companies involves strategic decisions around asset acquisition, disposal, and control transfers. By understanding and applying these principles, companies can significantly reduce their tax liabilities and improve their financial performance. Thank you for your attention, and I'm happy to take any questions you may have.